Charles Dow in 1897 had two market averages. Now those market averages are sort of like the indices that we see today. The S&P 500, the NASDAQ, the FTSE, the JSE all share. Okay? So he had these two market averages. The first one was the industrial average, which consisted of 12 industrial stocks, and the second one was the railroad average, okay, which consisted of 20 railroad stocks in 1897 already. Now these two indices, the way they moved, whether they were up or down, gave the investment community an idea of what the business conditions were like. So if the averages were down, then business sentiment was down and the whole economy was down. If it was up, then business sentiment was positive and the economy was booming. All right, so he followed these two market averages, and so did a lot of investors. Okay, nowadays it's combined. We see it as the Dow Jones Industrial Average. Okay, and that has quite a number of United States stocks on it, and we see it today. We compare our own JSE to the Dow Jones Industrial Average. So if the Dow Jones is up, what's going to happen the next day? The JSE will probably go up. There's a lot of other factors that will affect that, okay? But just for the history books. Right, now they say the market averages discount everything. So like I said before, everything you know about a company is already discounted in the share price, okay? And it's the same thing for the averages. The averages will tell you what the sentiment is, all right? The market has three trends: a primary trend, a secondary trend, and a minor trend. These are the assumptions of the Dow theory. Okay, so we have those three trends. Then it also has three phases. And then those market indices must confirm each other. So you can't have the industrial average up, okay, and the S&P 500 down. They're not agreeing with each other. They must confirm with each other, okay? Volume always confirms the trend. So the Dow theory will encompass volume a lot in the share price movement. Is the volume increasing in the direction of the trend, or is the volume decreasing in the direction of the trend? And then, like I mentioned earlier on, the trend remains intact until a definitive reversal has been confirmed. So there's no guessing. It's very easy. Right, now let's have a look at how that Dow theory confirms the trend. We already know that in order to determine which trend we're in, we need to find a series of lower or higher highs and higher lows, followed by a series of lower highs and lower lows. Okay, that is the Dow theory. So there we've got our higher highs and our higher lows. We draw our trend lines and we can see the trend is up, clearly. Lower highs, lower lows, we can see the trend is down. Then the three market trends. Now, in between these two lines, you can see I've drawn a nice little channel over here. We can see that the trend is up. Do you agree with me? Okay? Now, that is the primary trend. Now, the primary trend is also referred to as a bull market or a bear market. Okay? In this example, we're looking at the bull market. Now, within the bull market, okay, of this particular share that we're looking at, you've got the primary trend. This is a long-term trend. This can last many years, 5, 6, 7 years, long-term trend. Within that, you get a secondary trend. Now, a secondary trend is referred to as a correction, or it's a corrective reaction. Now, we all know that what comes up must go down, okay? Can't just keep on going up. And this is the cyclical nature that I'm referring to about each and every share. So the secondary trend is a correction, okay? It always comes back to a certain level, which we will get to in later stage of the seminar, but it is a retracement of the primary trend, okay? It can last 1 to 3 weeks, and normally can retrace 1/3 to 2/3 of that primary move up. Then within that secondary trend, you also get the minor trend. Now for the long-term investors, you don't look at the minor trend because that's just going to give you a whole lot of whiplash and market noise, okay? So we're not concerned with the minor trend when we're long-term investors. Short-term investors, yes, you could take advantage in the minor trend. Remember, it's within the secondary trend. You can take advantage of long opportunities where you want to buy, use a short-term instrument, buy a share, and also sell a share and make profit in the market while the share price is actually falling. Okay? So short-term traders would definitely look at the secondary correction phase as well as the minor trend.